Well, as always, let's start with the market and this late-day pullback on these tariff headlines. Let's bring in Charles Schwab, Chief Investment Strategist, Lizanne Sonders. Lizanne, happy Friday. Good to see you.
Happy Friday to you too, John. Thanks for having me.
So we've had market attention shifting from rates to DeepSeek to tariffs. When are investors going to know whether to treat tariffs more like a global reality or a negotiating cudgel, and how to factor that into their investing strategy?
Does the I don't know emoji work here in response to that question? I have no idea. Nobody has any idea. So I think this is not yet. I mean, we now know the date is a little bit earlier than what even some within the administration had suggested when, as of yesterday, even this morning, it looked more like an early March thing. Now it's an early February thing. So this is a moving target, and is one of the pages from the 2018 playbook that I think is applicable this time. It's just the manner by which policy gets announced, often by social media, shooting from the hip sometimes. I think the background conditions are a lot different than what existed in 2018, but that is going to be a volatility driver. But you also mentioned the others in different segments of the market. I think small caps to some degree are at the mercy of what yields are doing. Obviously, individual stocks are impacted by earnings. The misses have been hit disproportionately relative to the beats getting rewarded. So there are a lot of different forces driving different segments of the market. I don't think that changes anytime soon.
Zooming out to the macro and the consumer, data showed that personal spending is above personal income for a second month in a row, and we know more consumers are having trouble paying off their credit card bills every month. Is that a yellow flag, you think, for anyone?
Maybe a mild yellow flag. If you look at debt levels of any variety, revolving, non-revolving, you can look at it in an absolute sense, but you also have to look at it from a ratio perspective, whether it's relative to income, relative to net worth, relative to assets. And on those metrics, the numbers don't look quite as ugly. But certainly, you've got a bifurcated consumer, and those down the income spectrum, particularly given all the excess savings in that cohort has been worked off. They don't have that traditional savings. Even the savings rate broadly is down to only 3.8%. So I think what will keep the consumer afloat is consistent strength in the labor market. I think that has been the most important pillar for the consumption side of our economy. Job reports are always important, and next week's is important. But I think really keeping an eye on the labor market is key, not just in terms of the consumption side of the economy, but obviously because of Fed policy as well.
Lizanne, I mean, I would say it's a spicy start to the year here, given the fact we did see that pullback in stocks halfway through the month. It's kind of incredible. We're actually finishing the month with all the major averages higher, even though we're lower this week for the S&P and the NASDAQ. But if you look at a 1-month chart of the S&P and you put it up against a 1-month chart of the 10-year Treasury yield, it is almost a completely mirror chart from an inverse standpoint in terms of where we saw the highs for yields is where we saw the lows for stocks. So clearly we started the year with stocks taking their cue from the bond market. Is that something that continues?
I do think it does. And I think it's both a function of level in terms of, say, the 10-year yield, but also speed of moves. And in particular, as you go down the cap spectrum, given that smaller companies have more variable rate debt relative to many of the larger companies that have actually benefited from a higher rate backdrop because they're earning more interest on their cash and they're paying interest on their debt. So I think swift moves up to the extent we get it in yields, not to mention levels like 4 3/4, certainly 5%, probably has a disproportionate impact in a negative sense down the cap spectrum. But I do still think it's one of the things in the driver's seat for the equity market, even broadly.
Gold's record highs again this week, another strong month, especially in the midst of all of this uncertainty around things like tariffs. Is that something you buy into here?
Yeah, so I'm not a gold expert, nor would I necessarily classify myself as a gold bug, but I think it represents not so much an inflation hedge, and I use that word somewhat generically, not specifically. I think what gold is represented in precious metals, maybe more broadly, is a way to protect a little bit against geopolitical uncertainty, and that would be inclusive of tariffs because of the multilateral nature of them. So I think gold does make sense in a portfolio. The one thing to be mindful of in areas like that, whether it's precious metals, whether it's commodities, even in currencies, is there's a lot more day-to-day trading in these asset classes, including by individual investors, which means you've got to bring a sentiment component of the analysis in there. You can get swings that maybe move outside the bounds of what the fundamentals would suggest simply because of sentiment. And I think that needs to be a factor taken into consideration for investors going into those alternative asset classes.